What if the biggest risk to your AI portfolio isn't a new competitor or some kind of government regulation, but a single number? A number buried deep inside a Dutch company's earnings report that most of the market just glanced over. Well, that one number just put the entire AI hardware supercycle on notice. The key is understanding the timeline. You see, there's a huge lag, a delay, between the companies that make the incredibly complex machines and the companies that use those machines to make chips. And that delay, that's where the real story is right now. Alright, if you're short on time, here's the takeaway for today's story. ASML, the company that builds the literal foundation for every single advanced AI chip on the planet, just reported a collapse in its future orders. This is the first real, data-backed crack in the AI growth story. The next domino that you have to watch is TSMC's earnings report. Their capital spending numbers will either confirm this slowdown is real or prove the AI boom can somehow defy gravity. Hey everyone, my name is DataCat. For a long time I was an analyst working inside one of those giant Fortune 50 companies. You know, staring at spreadsheets until my eyes blurred, trying to connect the dots. I guess you could say I've traded that corporate grind for a keyboard and a laser pointer. I'm not here to sell you anything or promise you the moon. My goal is just to follow the data, because the numbers, well, they don't really care about hype. This channel is pretty new, so if you find my 2 cents valuable, hitting that subscribe button would be a huge help. It just lets me know that I'm on the right track. Okay, enough about me. Let's talk about that huge drop in ASML's stock. This was not an overreaction. The market, for once, got it exactly right. The reason is a trio of warning signs in their data. First, and most importantly, was the collapse in future orders. They recognized 5.6 billion system sales this quarter, which sounds great, but they only booked 5.5 billion in new orders. This gives you what you call a book-to-bill ratio below 1. To put that in simple terms, imagine you run a high-end bakery. If you sell 100 custom cakes but only get new orders for 90, you know you're going to have a problem down the line. You're burning through your existing orders faster than you can replace them. For a company like ASML, a book-to-bill that's far below 1 is a classic recessionary signal. Second, their profitability is getting squeezed. Gross margin is set to fall from nearly 54% down to a range of 50 to 52%. Management said this is because they're selling more of their brand new cutting-edge high-NA tools. These new machines are amazing, but they're less profitable at first. It's a bit like a cat bringing you a gift. Yes, those that you then have to deal with. Thanks for the new tech, but it's messing with the bottom line. And third, management basically warned everyone that their revenue for the year is heavily skewed towards the final quarter. This increases the risk of a miss. If anything goes wrong in that last quarter, the whole year's target is in jeopardy. They have very little visibility, and they said the word uncertainty a lot. When a company that's supposed to be the bedrock of a boom talks about uncertainty, you have to listen. So you may ask, if ASML's data is so bad, then why didn't other big tech or AI stocks follow and fall off a cliff right away? This is the most important part to understand. It's all about the supply chain and that timeline lag. Think of it this way. ASML is the shovel maker. They build the incredibly expensive bus-sized EUV machines that are essential for making advanced chips. Their weak orders tell us that their customers are planning to dig fewer new mines in 2026 and 2027. TSMC is the mine operator. They buy the shovels from ASML and run the multi-billion-dollar factories or fabs. And Nvidia is the gold prospector. They are selling every chip they can get their hands on, which are made by TSMC in factories that were equipped with ASML machines ordered years ago. The market is mesmerized by Nvidia's gold rush right now. Again, it's like a cat chasing a laser pointer dot on the wall. And as always, it's ignoring the person holding the laser pointer, ASML, who is signaling they're about to put it away for a bit. Now, let's pull up the chart. I know these can sometimes look like random squiggles, but this one tells a very clear story. Look at this massive gap down on the day of the earnings report. In technical terms, this is a bearish engulfing candle. It means the sellers showed up in force and completely overwhelmed the buyers. All the optimism from the previous days was just erased. And look at the volume down here. This wasn't a quiet drift downward. This was a stampede for the exits. This is what it looks like when big institutional money decides to sell. It confirms the move has conviction behind it. The stock also sliced right through its 20 and 50-day moving average, the blue and orange line here. That line was acting as a floor, a support level. Now it's going to act as a ceiling or resistance. The next major line of defense is way down here, the 200-day moving average, which is the classic indicator of a long-term trend. Now, after a drop this violent, you have to be careful. We might see a small, temporary relief rally in the coming days. And well, as a cat, I feel obligated to mention the possibility of what traders call a dead cat bounce. It's a grim term, I know, but the idea is that even a dead cat will bounce if it falls from a great height. It's a short-lived hop that can fool you into thinking the worst is over. But any bounce like that is likely to be met with renewed selling pressure, especially as it gets close to that broken 50-day moving average or the $770 level. It's a classic trap for anyone thinking they're buying a dip. A real recovery would need a fundamental reason to happen, which brings us back to the main event, which is the next big tell. All eyes are now on TSMC's earnings. This isn't just another report. This is the one that connects the dots. It closes that time lag we talked about and gives us a direct look at the health of the entire ecosystem. There are 3 specific data points to watch. First, capital expenditure, or CapEx. This is their budget for new factories and machines. If TSMC lowers its CapEx forecast, it directly validates ASML's warning. Second, demand for their most advanced 3nm and 2nm chips. This is the stuff that goes into Apple, AMD, and Nvidia products. Any sign of softness there is a direct hit to the AI growth narrative. And third, their factory utilization rates. If those rates dip, it means they aren't even keeping their current factories busy, which would be a deeply bearish sign. So to wrap it all up, ASML has sent up a flare. A very clear, data-backed warning that the ground beneath the AI hardware boom might be shifting. The market is currently acting like a cat that's heard the can opener but hasn't actually seen the food yet. It's optimistic, but the real test is what's inside that can. And that can is TSMC's earnings report. Every single support means a lot to this new channel. Consider subscribe if you like this kind of content. Let me know what you think in the comments below. Do you think this is the beginning of a bigger correction, or just a temporary bump in the road for the AI story? I read all of them. This is DataCat, returning to my catnap now. Thanks for watching, stay sharp.